The Fed cuts rates and everyone thinks home prices are about to drop. I'm here to tell you that's completely wrong. And I've got 50 years of data to prove it. Stick with me, because what the numbers actually show is going to surprise you. Here's the logic everyone uses. The Fed cuts rates, mortgage rates drop. More buyers can afford homes. Sellers get nervous, prices fall. Sounds completely logical, right? But here's the problem. That logic skips a critical step that most people don't know about. The Fed does not directly control mortgage rates. Most people think they're the same thing. They're not. The Fed controls the overnight lending rate between banks. That's it. That's all they set. Mortgage rates, the 30-year fixed rate when you buy a house, those follow the 10-year Treasury yield. They're driven by inflation expectations, economic outlook, and global bond markets. The Fed is just one input, which means the Fed can cut rates and your mortgage rate might barely move, or it might actually go up. And we don't have to guess about this. We have proof from last year. The Fed cut rates 3 times in 2025. 3 cuts totaling 0.75%. You know how much mortgage rates dropped? 0.54%. That's it. The Fed cut 3 times and mortgage rates barely moved. The myth said prices would crash. They didn't. The market held because the myth was wrong. So let's look at the actual data. I looked at every major rate cut cycle over the last 50 years. 4 cycles. Different presidents, different economies, different markets. And in every single one, here's what happened to home prices. Not once, not one time did the Fed cutting rates alone cause home prices to fall. Not once. Cycle 1, early 1990s. Mortgage rates dropped from 10% all the way down to 7%. That's a massive 3 percentage point cut over 4 years. Home prices, up 2%. Not down, up. Even with a sluggish economy, even with rates dropping significantly, home prices didn't crash. They ticked up. Cycle 2, early 2000s. After the dot-com bust, the Fed slashed rates from 8% all the way down to 6%. Home prices, up 40%. 40%. Rates fell, cheap money flooded into real estate, buyers came rushing in, and prices absolutely exploded. The complete opposite of what the myth predicts. Cycle 3, 2007 to 2009. And yes, this is the one everyone points to. Prices fell 17%. I'm not going to pretend they didn't. But here's what people get wrong about 2008. Prices didn't fall because the Fed cut rates. Prices fell because of massive mortgage fraud. Fake income documents, no income, no asset loans, toxic derivatives that nobody understood, collapsing the entire financial system. The Fed was cutting rates to stop the collapse, not cause it. That's a completely different situation from anything happening in today's market. Nothing like today. Nothing. Cycle 4, COVID 2020. The Fed slashed rates to near zero. 30-year mortgages dropped from 3.7 to 2.7%. Home prices went up 14% in just the first year. Then another 20% on top of that over the following 2 years. Rates dropped, buyers flooded in. Supply was already tight. More demand, same supply. Prices went up every single time. Look at this chart. 3 out of 4 times the Fed cut rates, home prices went up. The only time they fell was during the worst financial fraud in American history. That was not a normal market cycle. That was systemic collapse. The pattern is clear. The data doesn't lie. So where does that leave us right now? May 2026. 30-year mortgage rate, 6.23%, down from 6.91% in January of last year. Median home price, $410,000. Inventory, 1.93 million homes for sale, up 4.6 year over year. Annual price growth, 1.2%. Not crashing, not surging, stable. This is what a normalized market looks like. Here's how rates have moved since the Fed started cutting. January 2025, 6.91%. 3 Fed cuts later, we're at 6.23% today. The next cut is expected around September 2026. Forecasters are projecting 5.8 to 6.2% by the end of the year. Rates are not crashing, they're easing, slowly, steadily. And each time they tick down, more buyers qualify. Here's the supply side most people completely ignore. Over 60% of homeowners in America have a mortgage below 4%. They bought or refinanced when rates were at historic lows, 2.5%, 3%, 3.5%. Selling their home means giving up that rate forever. Their new mortgage would be at 6.23%, over double what they're paying now. So they're not selling. Supply stays constrained. As rates ease and more buyers enter the market, you've got more demand competing for the same low supply. That doesn't push prices down, pushes them up. Let me show you what a rate drop actually does for buyers. On a $400,000 home, at 7%, your payment is about $2,661 a month. Rates drop to 6.5%, that payment falls to $2,528. Down to 6%, $2,398. At 5.5%, $2,271. Almost $400 less per month than the 7% scenario. Every 0.5% drop adds hundreds of thousands of newly qualified buyers to the market. More buyers, same low supply. You already know what happens to prices. So what actually happens to home prices when the Fed cuts rates? The myth says prices drop, sellers panic, buyers win. The data says prices hold or rise. Lower rates bring in more buyers. People who were priced out suddenly qualify. Sellers with sub 4% mortgages stay put. Supply stays low. More buyers competing for fewer homes. That's not a recipe for falling prices. That's a recipe for prices holding or going up. Let me knock out the 3 biggest myths people are operating on right now. Myth 1. Wait for rates to drop. Prices will fall. Reality. History shows prices rise when rates drop. More buyers means more competition. Myth 2. The Fed controls mortgage rates. Reality. Mortgage rates follow the 10-year Treasury, not the Fed funds rate. 2 different things. Always have been. Myth 3. 2008 proves a crash is coming. Reality. 2008 was caused by mortgage fraud, not rate cuts. There is no comparison to today's market. If you're a buyer, here's what the data says to do. Don't wait for prices to drop. 50 years of history says they won't. Buy now and refinance later when rates fall further. You can refinance a rate. You can't go back and buy at today's prices in 2 years. Every month you wait, more buyers are re-entering the market. The competition today is actually lower than it will be in 12 to 18 months. And here's the thing, inventory is up 4.6% year over year, and you have more options right now than buyers did in 2021. This is actually a healthier buying environment. If you're a seller, more buyers are coming as rates ease. That's good news for you. But here's the thing, inventory is rising too. As rates fall towards 5.5%, 5%, more of those homeowners with locked-in rates will start to unlock. More listings will hit the market. Right now, your home faces less competition than it will in 12 to 18 months. Price it right. Use the comp data, not hope. Buyers in 2026 are informed. Overpriced homes sit. Correctly priced homes move. The window is open. It won't stay open forever. Here's the big picture. The market already reset. This isn't 2021 frenzy, and it's not 2008 collapse. Median price, $410,000, up $94,000 since 2020. Rates are at 6.23%, down from 7.79% at the peak. Price growth at 1.2%, stable. Not crashing, not surging, normal. Stable. That's what a healthy market looks like. The crash everyone's been waiting for since 2022, it's not coming. Let me do the real math on waiting. That $400,000 home today, at 1.2% annual appreciation, is $404,800 in 1 year. $409,658 in 2 years. $414,574 in 3 years. Now let's say you wait 3 years and rates drop to 5%. You save about $285 a month on your payment. But the home is now $14,574 more expensive. At $285 a month in savings, it takes over 4 years just to break even on the higher price you paid for waiting. And that assumes rates actually hit 5%, which isn't guaranteed. The math doesn't support waiting. Quick note on sources before we wrap up. Everything in this video comes from public data. Freddie Mac, the Federal Reserve, the National Association of Realtors, Redfin, Case-Shiller, and Kiplinger's 2026 forecast. All sources are linked in the description below. 3 things I want you to walk away with from this video. Number 1, the Fed does not control mortgage rates. Those follow the 10-year Treasury. 2 different things. Number 2, rate cuts historically bring more buyers in. Low supply plus more buyers equals prices that hold or rise. 50 years of data proves it. Number 3, 2008 was fraud, not a rate cycle. Today's market has none of those conditions. There is no comparison. Fed rate cuts do not automatically lower home prices. History shows prices usually hold or rise when rates fall. The market already reset. Rates are easing. Waiting for a crash that history says won't come could cost you more than the rate drop saves you. Follow for more data-driven real estate content. No hype, just facts. If this video helped you, subscribe. I drop data-driven real estate breakdowns every week. No doom, no hype, no clickbait, just the actual numbers. Hit the notification bell so you don't miss it. And drop a comment. Are you buying, selling, or waiting? I read every single one. If you like this one, you'll want to check out my other breakdown videos. And if you're in the Atlanta area and thinking about buying or selling, my contact info is in the description. I'm Scott Middleton, Tattooed Realtor Atlanta. Let's talk.